Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Amazon. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsey. Well, we're heading into the holidays. We got kind of a mixed numbers today in all the markets. What do you see in the SPX this week?
Yeah, I mean, after last week, which was kind of a little bit of a downer, the S&P 500 ended the week in the red. We are seeing what was a nice update this morning. We're getting a little bit of a mixed feeling at this point in time. New York City Mayor de Blasio came out and said that a full shutdown could be on its way for the big city. So, having investors brace for that has taken a little bit of the momentum that we had this morning off the table. But really today, it's all about the deployment of the vaccine. Pfizer's vaccine was administered to the first person in the U.S. this morning. So investors were feeling pretty good about that. Also, by the way, Brian, Moderna, the FDA is going to have an advisory council meeting on Thursday. So we should see that vaccine cleared for emergency use as well by the end of this week. At least that's what the market's expectation is. It's really, truly been incredible. You and I have been watching the biotech and healthcare space for the past year, and especially in the last several weeks, as some of these vaccines have been deployed or the test results have come out and now are preparing to be deployed. And it's really been a fantastic ride to watch. It's really just history being made. It's, I think, the fastest that we've seen a vaccine developed, tested, and manufactured in our country's history. So I don't think that should be underappreciated by the market. And so that's why you've seen the market move higher. I think in the last, if you look at the stock chart of the S&P 500 here, we have that red line that takes us all the way back to early September at the top there. We broke through that in late November and have been steadily above that, even if with a little bit of a pullback that we got last week in the S&P 500. We could be getting a little bit stretched when you look at some of those moving averages, Brian, that you have on the chart. The 200-day is all the way down there at 31.77. So a ways away, which could mean there's a little bit of uncertainty. But this is a big week from an economics perspective, from a data perspective in general. We're going to hear from the Fed. I think that also the focus this week is going to return to the stimulus. I've been saying for several weeks now that several months, stimulus has been a key component to market action here. And we're expecting to hear news on what a bipartisan stimulus package can look like. There's talk right now that $908 billion package that they've been talking about for a couple of weeks now can be split into two packages, with the bigger of the two just under $750 billion to really be focused on small businesses and the consumer, and the remainder part focused on state and local governments and liability concerns. So I think that's going to really play a role in what direction the market can go in from here. We're going to talk about in the VIX in a minute. It remains stubbornly above the 20 level, which means there is this level of uncertainty in the market. But stimulus is the one thing that market participants have continued to look at to really override any slowing in economic data or even earnings data. That we just had a really strong third quarter. People are looking out to the fourth quarter. We do get a couple of earnings announcements this week. FedEx is coming out. We'll get Nike at the end of the week. Darden restaurants. And on Wednesday, we get Lennar, one of the home builders. So there's a bunch of stuff to chew on this week. And so the market can really go anywhere, I think. And I don't know if I mentioned with this Fed meeting too. So we'll hear from the Fed on Wednesday. But so a lot to really digest this week ahead of next week, which is the week of Christmas, and probably lower volumes next week. So we'll keep an eye on that. But Brian, I wanted to again talk about the VIX being elevated, and not only that, we're seeing a trend that we saw late in the fall ahead of the elections, whereby the out months VIX futures contracts are higher than where we're at today. What does this tell you, and how does it relate back to those what we saw back then?
Well, yeah, I did. So we now have the March futures contract available via our platform, via the CBO indexes that track it. And I added that to my watch list that we've been looking at. This is just a general watch list overall. And we see these are all the futures contracts. We see the actual VIX index, the actual spot index, trading around 23% implied volatility. We have the January contract going all the way out to about 25%. The December contract's going to come back in. It's going to actually start trading very close to where the actual VIX is at because they're approaching expiration. But what I found interesting is that the March contract is trading up higher than the February and the January contract. It's actually still up around 26% implied volatility, meaning that marketplace, once again, is still thinking that this is here to stay. No matter how much good news can come out on the marketplace, we see the VIX still stay elevated. And I'll highlight it over here on the chart. We've always talked about this 20% level, just real interesting area that the VIX just can't seem to get below. Right now, we actually are up a little bit today. We're at 23.41 on the actual spot. We came down and when I say spot, that's like a futures term, just saying the actual index. And we see it down around 20% here. It came down, touched that level, went shooting right back up. So no matter how many new highs we can set in the market, no matter what index is leading the way, the VIX just won't seem to come off until we have some more certainty as far as I guess the vaccines are concerned. And the worry about the shutdown is still real. We still don't have the stimulus, even though the talks are every week they say, oh, the talks are going good, and then we still get nothing overall. But one other thing that I just kind of wanted to highlight a little bit here too is that I'm going to pull up one more chart here before I move on and pass it back to you to talk about Amazon. Is the Russell 2000, which we're showing you the IWM, which is the ETF that tracks it, has gone parabolic here. And I just find that very interesting and worth noting. Even though we're setting new highs, this was back in March where the Russell was at. It took forever to make that movement back. And then we see as soon as we broke through that high, that resistance level to the upside, we all of a sudden there's just been no stopping it. Now, it is a little bit overdone in that we're about 24% above where the 200-day moving average was at. That was about 46 points overall. So a little bit frothy on the market, but kind of the reason why we're looking at Amazon a little bit today, because what we've seen is the small caps are leading the way, but now the FANG stocks have kind of slowed down. Ever since the news of the vaccine has came out, stay-at-home stocks are not in quite as high of demand, and that's kind of hurt the FANG stocks, which Amazon is one of them. And so maybe it's time to look at it a little bit today. So what are we seeing in Amazon going forward, or in the short term going out into the new year, Lindsey?
Yeah, sure. Before I get into
too,
Amazon stock, I just want to remind our viewers that we will take your questions at the end of the show here. We always save time to take as many as we can. So be sure to type them out in the chat box over on the right that you'll see in the YouTube application. So with that, let's take a look at Amazon. Like Brian said, it's something, we've noticed the tech stocks have kind of fallen out of favor over the last month or so. So it kind of piqued our interest. While a lot of these large cap tech stocks, some of the FANG names, have seen a bit of a pullback, could this be a place where you could potentially enter into some of these names? And, as always, Brian will find a way for us to do that with options. So if we're looking at the stock here, They last reported earnings on October 29th. The stock had fallen right immediately after that, but since then it hasn't really done much. It was, just over 3,200 at that point in time, and now we're just below that today. So it's been kind of trading in this range here, really, since when is that peak there at the top of the line?
Right. Okay. So here's the 29th, Lindsey, that I'm highlighting.
Yeah, the 29th.
And then we came back on up
now.
and kind of, that was the start of that trend line that we see that I have drawn on here. And that's the 5th of November. But yeah, as you mentioned, a lot of chop, just deciding where they want to go with it overall.
Exactly.
At least we start seeing that.
A lot of chop. And I think that also coincides with investors' preference to rotate into some of the more cyclical or value-oriented stocks. Last week was the first week we saw growth edge out value for the first time in several weeks, and it barely edged out value. So it's, investors, I think, have really been shifting their focus to prepare for the end of the pandemic, the rolling out of this vaccine, and the reopening trade, even as cases have been rising. And you're hearing more and more states and cities put restrictions on consumers and restaurants and all of that stuff. Despite that, the market overall has moved higher, and the tech stocks have taken a back seat while some of those reopening stocks take the lead. But they haven't fallen off a cliff, which it has been important for the market over the last several months to continue to maintain its march higher. We can't have tech, which represents over 25% of the S&P 500, completely fall off the charts and expect the market to continue to go higher. But when I'm thinking about and looking at Amazon, even looking at some of these other FANG names, Amazon stood out the most to Brian and I when we're talking about which tech stock should we take a look at. While it's not entirely clear that this stock is going to move swiftly to the upside, the one thing that we like about Amazon, or find interesting about Amazon, is that it is a key participant in the holiday selling season. The retail business in Amazon is the biggest business these guys have. We saw strong numbers come out of them in the third quarter. Amazon in general has been a beneficiary of the pandemic as buying products and goods online accelerated significantly over the course of the pandemic. And then we saw Black Friday, Cyber Monday numbers on Cyber Monday, according to Adobe, were the highest they've ever been at $10.8 billion, growing 15% year over year. And of course, Amazon being a key beneficiary of that. And this is, thinking of the holiday shopping season, because more people were doing it online, and there was less likely to be a stampede of customers at physical stores on Black Friday, given the pandemic. Sales started in October, and people started shopping much earlier. So that is something that should bode well for these guys, and we'll get an early read on that. And the other thing with Amazon is that they typically have their Amazon Prime Day in July, which is a part of their third quarter. Well, that got moved to October, so that's going to be part of the fourth quarter. So the outlook that was given when they reported third quarter results for the fourth quarter was it better than expected on the top line growth, partially because of that. But there could be a possibility that these guys could surprise to the upside. They're not overly aggressive usually when they provide guidance. So we'll be watching for that on the retail side. They're also expanding into new categories, really pushing their clothing offering, really pushing some of their home goods and furnishing offering as well. Some of the baby offerings too, especially with some of those other brick and mortar retailers going out of business. But then you got the AWS business, of course, growing at a 29% clip in the third quarter, in line with the second quarter. That sales growth number has been decelerating over time just because of large numbers, right? But still, this is the part of the business that makes up 57% of profits for AWS, for Amazon as a whole. And that's going to continue, expected to continue. And in fact, this morning we saw an announcement with the Star Alliance, one of the largest airline networks, is moving all of their stuff to the cloud. Of course, these guys are becoming much more cost conscious in the wake of the pandemic. So moving their stuff from data centers to the cloud will certainly benefit them. So I think that's partially pushing the stock higher today, which is why you're seeing that little bit of a green pop, really touching that red line that we draw on the chart there. And also Cowen added it to, investment bank Cowen added the stock to its best idea list today too. So I think that's helping to drive the upside. Again, today, looking at the market, it's tech and small cap that are driving, which is a little bit of a dichotomy because like Brian walked through, the small caps are all about the reopening trade. Tech is more of a defensive play. And maybe that is aligning with what we're seeing in the VIX remaining elevated here in the near term. So there's a lot going on with Amazon. We like the prospects of Amazon going into the holiday shopping season. It could be a very good Q4 report, especially on the retail side. They're making some wins on AWS. But on the downside, there is always the cloud of antitrust lawsuits. Last week, we saw a big one brought to Facebook. Amazon does have one outstanding from the European Union. That'll be something to watch. But I think, as far when you think about those antitrust lawsuits, it's Facebook and Google that are probably more in danger than an Amazon or say an Apple. But they do exist and need to be taken seriously. It's just the market. I think investors don't really expect too much to come out of that, at least in the near term. So that's where we're at from a fundamentals perspective. But Brian, take me through the options. Like I said, it's, it could be a good fourth quarter. We're not really sure. Investors seem to kind of have wanted to give these guys a break. So what are you thinking from an options perspective?
All right. Well, let's start by looking at the chart because the chart is going to be essential in the actual option strategy that we're going to look at today. And as always, it's not meant to be a recommendation. We just always call it a paper trade here on the stock play of the day. And we're just looking when we see certain things in the marketplace, there's never a golden book of answer of this is the only option strategy. That's why inside the options playbook, we have over 40 different option strategies overall. But what might apply to the current conditions in the marketplace? And one of the biggest things that we see right now is volatility. We see volatility in the individual stocks. We even see it in the index, like the long conversation we just had about the VIX index. But if I look at this chart, I see this one area down here on Amazon. And this is an interesting area overall in that we've had 2 or 3 touches on this line to the downside, giving a little bit of support. On the upside, though, today, actually, we kind of talked about Amazon trying to break out. We have a few touches on this trend line right here to the downside. And I actually kind of clicked on it earlier when Lindsey was talking. I moved it a little bit. But right now, as we've been speaking, Amazon has been going higher, actually higher than when we just started the show. So if we get a breakout above that red line, that's a positive thing overall as far as the chart is concerned. It'd be good to close above this line, hopefully breaking through all this chop that we've had and eventually breaking out to the upside. That would be a good thing. But we have a line in the sand down here. This looks like a really solid area for Amazon. So we're going to just start by maybe selling a short put spread, and then we're going to look at a derivative of it in that in this marketplace, I've talked a lot about how can I sell some premium and try to help myself out in that I have a lot of risk when I'm doing short spreads. We have a lot of volatility. We can bring in a lot of premium overall, and it's always enticing to do a short put spread if you're bullish or a short call spread if you're bearish overall, but that comes with risk. You're bringing in a small credit and you have a large downside potential. So I've introduced skip strike butterflies and different forms of butterflies as an alternative to a short spread. The market's kind of moved against the strategy that I had today. So I'm hoping to get it done for a net credit. But we're going to start by looking at that short put spread. And we're going to focus on this area right down here. There's so much premium in Amazon. The markets are really tight overall that if you go to the downside, you will have a lot, you can get fairly far out of the money and still bring in a decent net credit to the account. Okay, so we're going to look at a short put spread, and I just want to kind of talk about the thoughts. And I've talked about this before, but it's a tough concept on not only the stock play of the day, but also on my midday market call and some of my podcasts. When we look at a short put spread, here's our whole goal, right? We're selling strike B, and this is inside the Ally Invest options playbook right here, optionsplaybook.com, available to everybody. But if I sell this short put at strike B, I bring in a lot of premium, especially in a stock like Amazon. But it's a pretty big requirement saying that I'm willing to buy that stock at that strike price, and Amazon's over $3,000. So that's a tough thing to say. So what do? You buy some protection. You bring in a big credit and you buy some protection. And then you have risk from strike B all the way down to strike A. You want the market to continue on up. That would be a good thing overall. We do like that because then we get the net credit. And the thing is, we have a high probability of success because we can get way out of the money. But if it does come down, it's going to go against us fairly fast. We buy some protection to try to protect that overall. But the net goal is to make that make the bulk of the premium or the net credit received from selling the short put spread. Okay, keep this graph in mind. Now let's look at a skip strike butterfly. Okay. Now, I know it sounds fancy, but all the skip strike butterfly really is doing, I mean, it's a lot of words overall, but if all it's really doing is you're selling that short put spread, and let me just act like I'm drawing a line right here, you're still selling that short put spread, but instead of keeping all that credit, you're actually bringing a hedge in or something to protect you, which is called a butterfly. So you're paying for that butterfly. So that means that if the market comes down, in our instance, we were talking about strike B, but in this graph, we're talking about strike C. That's the main strike that we're selling here. If it comes down to that level, closer to the expiration date, it actually gives you a little buffer. It gives you a little pillow to land on. And it's all about timing with these type of strategies, though, because when you initially put them on, you do need a few days to go by before the graph starts looking like it would be at expiration. So that's an alternative. And in this marketplace with so much volatility, not only in the indexes, but in the underlying stocks, it's a very interesting alternative to just doing the short put spread outright. Now, part of the reason why we always say this is a paper trade is that you need to learn how they're priced. You need to learn how they're moving. Our profit and loss graph will help us out on that. But let's go in, let's look at that option chain. Now, if I look at Amazon to start with, I'm going to move that box over here. Right now, we see that we're up 73% or 2.5% move, which is a fairly strong move in the underlying stock. And when I'm looking at Amazon, we're going to talk about the December 24th expiration. It's only 10 days away. And why are we only going 10 days? Because there's so much premium in it. We don't need to go out that much further and still get some value on this. And especially if we're doing the butterfly, if the market came down, we want it to come down closer to the expiration date as opposed to sooner. So picking that expiration is going to be fairly important because if we go further out in time and it comes down quickly, the benefit of the skip strike butterfly doesn't really help you as much. The fact that you have this butterfly in here that will pay you if it comes down to your short strike, that only maxes out closer to the expiration date. All right, I know a little bit of a advanced concept here, but let's go on in and we have the first butterfly up, but I'm gonna clear that out because the market has moved against me here. And let's just look at the short put spread. Now, the line in the sand or what we drew on the chart was all the way down around the 2880 mark. So if I were to do a short put spread, look at how much premium we can get going all the way down to the 2870 level. If we look at where the at-the-money option contracts are at, if you're buying an at-the-money option contract, it's going to cost you $6,100, and let's call it $6,200 to buy one option contract with only 10 days remaining. So it has a little bit of premium in it, but that premium comes from the fact that it is a $3,185 stock, and then you throw the volatility into the marketplace. So we'll start out by just looking at that short put spread, and then we'll explore a butterfly a little bit, see if we can get that done for a decent net credit to the account. So I'm going to sell the 2970. I want to get below that strike if I can. And then I'm going to go down to the 2960 level, and I'm going to buy that underlying. That's going to be my protection. So you have to go 10 points wide because there's no 5-point strikes. So in this instance, we're going way out of the money, all the way down to the 2970 strike put, but we're buying the 2960, bringing a net credit of about 70 cents to the account. And we'll make this the official paper trade for the week, the one that we'll look at on Monday, or on Friday, I'm sorry, in the overtime edition. But if I look at this underlying trade, another alternative is if the market does go against me, I can maybe roll into a different trade like a butterfly. So let's make this the official paper trade and put it in the right rail. This is how we would look to enter this order here on the Ally Invest option trading platform. We would be selling to open that December 24th, only 10 days remaining to expiration, 2970 strike. And at the same time, buying the 2960. We're going to try to work it at the midpoint. Never guarantee of a midpoint fill, but I'd like to get 75 for this. That's where the market was at just a minute ago. 70 cents is a little bit, I don't know. I'd really like to get $1 for it. So you're receiving about $1, but market's moved against us a little bit. So we're going to keep it right at 75 cents. That means the maximum we can make on this trade is that 75 cents for every 1-by-1 spread that we do, or $75 less commissions. Now we got a 10-point wide spread, so that's our maximum risk. It could trade for that 10 points. 10 points minus that net credit received would be $9.25. That's what my risk would be on this trade. Now we're quite a bit out of the money, so it gives us a chance to trade out of it if it goes against us overall. So if I saw this thing trading for $1.50 or maybe $2, right in that range, I would think to close it. I don't want to take that maximum hit if it starts going against me. Now, ideally, we would like to see it just break up above that and maybe continue to drift higher. One thing that's nice about a short put spread is that we're neutral to bullish on the underlying stock overall. And if I look at the profit and loss calculator here, okay, this is how far out of the money we are. Let me close the trade ticket. I got my screen way zoomed in here. We see that this gray line is representing where the underlying stock is at. This is the profit and loss graph at expiration. Now, if I zoom in a little bit, let me just zoom in just a little bit on this graph here. You see that because there's so much time premium, if it starts going against me, that time premium kind of protects me, right? So this is what the profit and loss graph looks like as of today, is that colored line. So if it starts going against me and gets down to this range, or even in this range, I want to think about getting out of that trade. Now, as expiration approaches, you'll see this line start to morph into this. And I'm going to go all the way down to 1 day to expiration because there's so much premium in this. And now all of a sudden you see what happens to that profit and loss graph. And with that last day, we get to this actual position here. So if it moves hard against me, if it ever did hit my long strike and I fell asleep and it hit it, I'm just getting out. I want to close that trade while I can still get some of that premium of being long an option contract that would be at the money. But I like this trade by looking at, we're doing it for 75 cents. If we see this trading for double when it goes against me at $1.50, I want to think about getting out of that trade at that point in time. On the way up, if I could close it for a dime or a nickel, I'm going to just get out of the trade too. I'm just going to remove it. But we only have 10 days remaining to expiration. So each day that goes by, you're going to see a lot of time decay in these option contracts, because I don't care what the price of the underlying stock or what the volatility is. When we get to expiration, if it's out of the money, it's got to trade for zero, right? It's that simple on these very expensive, volatile underlines. All right, so now I promise that we'll look at a little bit of the skip strike, and I'm just going to introduce this. Maybe we'll talk about it a little bit more on the overtime edition. But for example, if we were doing the skip strike butterfly, what we would do is we would try to bring in that net credit to help pay for the butterfly, but we're going to skip that strike, and that embeds a credit spread, and we would end up buying this strike. So this is what it would look like. And I'm going to just throw it in the profit and loss graph really quickly. And as I said, we'll talk about this. I'm getting a little long-winded. We'll talk about this at the overtime show on Friday, 1 by 2 by 1.
Brian, we are coming to time here.
All right, everyone. We'll let it go. I'll come back and I'll cover it today. Right now, that did not adjust the graphic. So, questions? Where are we at? Yeah, we're right at
a lot of questions. We're unfortunately at 12:30. How about one question at the end here? Murray Connerty asks, in general, what's a good rule for the width of credit spread?
Well, I like to look at the percentage amount. Now, if I'm selling a 2.5 point wide credit spread, I usually try to bring in 50 cents. I'm going 5 point wide. I'm trying to bring in $1. In this instance, we're going way out of the money, so I don't mind bringing in that 75 cents. But when we started the call, I was looking at $1 overall, and that's just because it's such an expensive underlying. But those are just my general rule of thumbs that I'm kind of looking for when I'm doing a credit spread overall. About 20% of the width of the strikes.
Got it. That's helpful.
You got to run?
One quick other question. Jeff
Okay.
Jan 14, what potential aid would the government stimulus bill offer to homeowners and mortgages? Right now, from what I've seen and heard, it doesn't look like homeowners necessarily going to have a specific benefit in the current package, but those that could be facing eviction, the hope is that those relief, the extension of eviction or non-eviction, I should say, gets extended into January at least. So we'll see what happens there. For homeowners, it has been a positive to have interest rates remain so low. The 30-year mortgage keeps hitting new lows. So if you haven't refinanced your mortgage yet, you should probably consider it. There are a lot of questions. We really appreciate everybody submitting the questions. A lot of stock-specific questions. We can't always address those, but we will try to address the ones that we can in the future when we have a little more time. We're over our time limit right now, so that's going to do it. But be sure to tune in on Friday for Stock Play of the Day Overtime with Brian on Friday at noon on the Ally YouTube channel.
Yeah, we'll explore the butterfly on Friday. I promise you, I had a little bit of technical difficulties making that graph work. I'll make sure it works on Friday. And that's going to be it for this episode of the Stock Play of the Day. Please click subscribe and ring the bell, and we'll see you this Friday at noon Eastern time for the Stock Play of the Day Overtime edition. Thanks for coming, everyone.